Hello guys, welcome to Bhavna's Online Academy. In this video, we are going to learn SA 240. This video will be applicable to both inter as well as final students, and the video will be a complete coverage of SA 240, and you will find the notes in my Telegram channel. Yes. So what is SA 240 speak about? So SA 240 is the auditor's responsibility. What is the responsibility of an auditor to fraud in audit of financial statements? While he is performing an audit of financial statement, if he comes across in fraud, what is his responsibility? This is what we are going to understand in the standard. So like always, before we get into the standard, let me give you a brief understanding of what the standard speaks about. So what happens is that there is a company, okay, and the auditor goes to audit such company. What happens is that today in the world we are living, it is very competitive, so everyone has something to prove that they are better than everyone else. And what people understand is either by hook or crook. Okay, you would have heard, no? Either by hook or crook, they want to prove that they are the best, or they want something. Yes, to prove that they are the best. Suppose if there is a company, what is the company's aim is to? The company's aim is to have the best financial performance. And if the company does not have the best financial performance, what happens is that the management is sometimes, you know, has the incentive. The management sometimes have the opportunity to do some fraud and show that their company is doing the best financial performance. So what this management does is that the management makes manipulation in its financial statements or accounting records in such a way that it shows that they have the best financial performance, like they can increase the revenue, reduce the cost, etc., in other ways too. Yes, so this is for the management. So a management level can do such a kind of fraud. Whereas there is one more aspect to this, which is the employee aspect. So here the employee is also living in a competitive world. So the employees will also have a lot of needs and wants to be fulfilled. So sometimes what happens is that to fulfill the need and want, by either hook or crook, he applies some methods. Like what he does it, he steals some property from the the office. Examples, what he does it, he does not want to spend extra money on stationery or something. Okay, he believes a lot of cash might go waste in it, so what he can do is all the office stationery, whatever is there, he can keep on taking it home. So like this, a little fraud these employees can also commit, whereas the management is capable of committing bigger frauds. Okay, employee can also commit bigger frauds, I'm not saying that, but usual circumstances, general circumstances, what happens is that the employee usually does little frauds and the management does the bigger financial statement frauds. Okay, so what is his responsibility of this, what is the responsibility here of this auditor? Okay, so where is auditor's responsibility come into play? So here, like you understood, there can be a fraud at two levels. Okay, one is the financial statement level, and the other we understood was the asset level. And tomorrow what happens is that if tomorrow, suppose there is a fraud which comes out of about this company, a fraud case comes out about this company, then the external people are going to come and tomorrow question the auditor also. See, one you have to understand is that it is the management's primary responsibility. Whose primary responsibility? It is management's primary responsibility to either prevent or detect the fraud. Okay, but since the auditor is also examining all the financial statements here, it becomes auditor's responsibility also to make sure while he is auditing, if he comes across any fraud, then he has to report it. Okay, but here if the auditor is able to prove using his documentation and his work that whatever audit procedures he has to perform related to a particular area, he has performed that perfectly, and there was nothing more he could do about it. Whatever audit procedures and audit documentation he had to do, he had done it properly, then he will not be held liable. Otherwise he is going to be held liable. So you remember the case of Satyam Computers. In Satyam Computers, what happened? They had done some manipulation in the financial statements only, but and the question was raised to the auditor that why you did not find out the fraud. It is not your primary responsibility, we understand, but you, since you have gone through the entire financial statement, you should have known how you did not find out. So if the auditor at that time could have proved that, I performed all the audit procedures perfectly, I did all the documentation perfectly, but I still couldn't find out the fraud, then it's fine. But here what happened, the auditor did not perform the audit procedures properly, so they were also held liable in the case of this fraud. Okay, yes, I hope you have got a brief understanding of what this standard talks about. Let's move into the main context of the standard. Yes. So essay 240, like I told you, this essay tells you in the related to the fraud in the audit of financial statements. That means fraud related to the financial statements. In that case, what is the auditor's responsibility? This is what we are going to understand. So first, let's understand the term what is fraud. So one, before we get into this, you have to understand that there might be two terms. One is error and the other one is fraud. Okay, so a financial statement might be misstated due to an error or due to a fraud also. So error usually is unintentional, that you had to put suppose six zeros and you forgot to put one zero by error, by mistake. So this is like a unintentional thing. But fraud is when you know that you're doing a wrong thing and you're doing it. So fraud is intentional. Okay. Yes. So fraud is a intentional act where the management, TCWG, the employees of the company, or any third party is doing anything which is to deceive the users of financial statements so that they can obtain an unjust or illegal advantage which is not fair. So the people of the company are doing an intentional act to create an unjust or illegal advantage, that is known as your fraud. Okay, and whose primary responsibility is the fraud? Primary responsibility of prevention and reduction of fraud is of the management and TCWG. Okay, yes. What is the auditor's responsibility here? So what is the auditor's responsibility? In essay 200, what did we learn? Auditor has to obtain a reasonable assurance that the financial statements are free from material misstatement either due to error or fraud. So here what they are saying, auditor, listen, you have to go and examine the financial statements, but please make sure that the financial statements are free from material misstatements. What is material misstatements now? Material misstatements, let's understand. What is a misstatement? Misstatement means, mis means any wrong. Okay, like you say, no, mischief, something like that. So miss means anything which is wrong. So miss means anything which is wrong or unsuitable, and statement here refers to the amount, classification, or presentation and disclosure of financial statements. So if there is any wrong in the amount, classification, presentation and disclosure of financial statements, then it will be known as a misstatement. And when does it become a material misstatement? Material misstatement will become, so a misstatement can be a 50 rupees also and 50 crore rupees also. Okay, so a misstatement can be both. If there is a wrong amount of 50 rupees in the financial statement, then also it is a misstatement. If there is a wrong amount of 50 crore rupees in the financial statement, also it is a misstatement. So here what is a material misstatement? A material misstatement is such a misstatement which will affect the decision of the users, which will affect the economic decision of the users. Now if I'm going to go and see a material misstatement, a 50 rupees error or fraud will not affect me, but a 50 crore rupees error and fraud can affect me. Okay, so if I am an investor and if I am thinking that I want to go and invest in a company, 50 rupees will not matter to me, but an error of 50 crore rupees can matter to my decision, can take a hold on my financial decision. So whatever is affecting the financial decisions or economic decisions of an users, it will be known as a material misstatement. So the auditor must make sure that he is making sure that the financial statements are free from the material misstatement, like something like a 50 crore rupees misstatement. He must make sure that the financial statements does not have it, it is free from it. It can either be due to error or fraud. This misstatement can be either due to error or fraud. So you have to make sure, auditor, and for that you have to give us a reasonable assurance. This is the auditor's first responsibility. The second, the auditor should also understand, and the management should also understand, that due to inherent limitations, maybe for example due to limitation of time, the all the misstatements may not be deducted. 100% all the errors cannot be deducted in a company. Okay, so and the next thing what they are saying is that the risk of non-deduction of fraud will always be greater than an error, because what happens, a fraud is a sophisticated and carefully organized scheme. So when something is so carefully organized, deducting it might be difficult, whereas an error is unintentional, so you will not do anything to cover it up. So what can happen is the deduction of the error will be easier than deduction of fraud. Okay, next they are saying that the risk of non-deduction of management fraud is higher than the non-deduction of employee fraud. So if employee is committing a fraud and tomorrow what the auditor has some doubt about it and he goes and asks the management will accept that, see, I don't know anything about this, and the employee can easily get caught. But if the management himself is involved, then in such case what might happen, the auditor will go and question the management, and the management is rather going to try to cover it up. So finding out the management fraud is difficult than finding out an employee fraud. Okay, and finally the auditor should obtain a written representation from the management or TCWG. What written representation should he get from the management or TCW is that he should get that, management should write and give us that, management, as management I have performed all my duties of preventing and detecting the fraud, and according to me there was no deduction of fraud in the current year. Okay, so there was no fraud that has happened or suspected to have happened. So like that he must get a written representation from the management also as an additional evidence. Okay. Yes. So if in case if the auditor comes across any fraud, then he shall report it into the section 143(12) of the Companies Act, and also in the clause 11 of para 3 of CARO. Okay. So wherever the question of fraud comes, you can easily quote this and come. This both I believe you have understood and learnt in law, so I'm not touching much upon here. So he shall report the fraud in the section 143(12). I think more than 1 crore fraud can be reported here of the Companies Act, and in the clause 9 of para 3 of CARO you can give a disclosure about such fraud. Okay, yes. Then what are the auditor's duties? First you have understood what is the auditor's responsibility. Now you have to understand what are the auditor duties. So the auditor should always maintain professional skepticism while he is performing an audit. He should always have a questioning mind. Yes, and he should always have a alert mind and a questioning attitude, so that he is able to find the frauds in the company. Second is that he must always recognize the fact that there can be a possibility of fraud anywhere and everywhere. If he has been auditing the company for the past 10 years and the company has a clean record, does not mean that on the 11th year also it will not perform any fraud. So auditor must always think whenever he's going for an audit that there can be a possibility of fraud. Okay. So unless he's not doubtful about it, he can accept everything that is given by the company as genuine only. If any document the company is presenting to the auditor as an evidence, then if the auditor is not doubtful about it, then you can accept it as genuine. But if you are doubtful about it, that you have a condition to believe that the documents that are presented by the company are not authentic, then you can investigate it further. Then what you can do is, while you are investigating, you can investigate the management also, the TCWG also, the employees also. But if the response is inconsistent with whatever understanding you have had now with the company, then in such case you can investigate such inconsistencies also. Suppose you have understood certain things about the company, okay, and what the management is telling is totally different from what you are understanding it. So in such case, such inconsistencies also the auditor can audit and understand, okay, and investigate. Fine. Yes, I hope you understood this. So first we understood what is fraud, then auditor's responsibilities and auditor's duty, and where he can report the fraud. Next we are going to understand about two types of fraud. One is fraudulent financial reporting and the other one is misappropriation of asset. I told you, the employee steals the stationery from the company. It is an example of misappropriation of asset. Asset of the company are stealing and taking away with you. Whereas fraudulent financial reporting, what example did I give you? I told you, that 50 crore rupees they are making some misstatement, like suppose they are increasing the revenue by 50 crore rupees in their financial statement. So such case is a case of fraudulent financial reporting. That means in your financial statements you are reporting something which is fraudulent, which is not true. Okay. Yes. So first let's understand about fraudulent financial reporting. So it means it is any intentional word is very very important here. Intentional misstatement or omission of amounts or disclosure. So it can either be a misstatement where you are writing something wrong in the financial statement, or omission, you have not written it at all, or some disclosure also you are making wrong, okay, in the financial statement to deceive the users of financial statements. So people who are reading and understanding the financial statements will not get the true picture of the companies. You are trying to deceive them. So such a reporting will be known as fraudulent financial reporting. How can you do a fraudulent financial reporting? How can it be accomplished? By first, you can manipulate the accounting records. You can increase the revenue, you can decrease the cost to show more profits. Second is you can misrepresent any significant information in the financial represent. In the financial statement, some significant information is there about the company. Okay, suppose they have a contract. This contract is not yet signed yet, but they are in the deal of making such contract. Now what you can do is you can misrepresent such significant information. Suppose you are going to get a revenue worth 100 crore from this contract, but you are showing in your financial statement as if this contract has already been entered into and already you have got that 100 crore rupees. So you are misrepresenting some significant information in the financial statements. And finally you are misapplying the accounting principles so that you get an advantage in the financial statement. So by these three methods methods fraudulent financial reporting can be done. Manipulation, misrepresentation, and misapplication. Manipulation of accounting record, misrepresentation of significant information, and misapplication of accounting principles. So what are the techniques by which you can do such financial reporting fraud? So usually what happens is that the financial reporting fraud usually happens at the management level. Usually management is involved in doing such fraud. So management will have some controls over them, but the management are going to override such control and do whatever they think is right. So by what techniques can they do such management override of controls and do such fraud? First is they can pass some fictitious journal entries, the journal entries which are not true, which is not real. They are passing such journal entries to get an advantage. And then the second is inappropriate adjustment of assumption. So here you had to take an assumption that is suppose the discounting rate of 7% you had to apply, but you are taking some inappropriate assumption, and you are doing some adjustment according to yourself only, so that the values are shown in a better picture. Okay. Yes. Next is you enter into such complex transactions that there is not one way of accounting it. There can be two to three ways of accounting it, and you are choosing the best way of accounting it and getting to your advantage. The second is altering records. Like I told you, you can increase the revenue, decrease the cost, altering the records, whatever are there, your P&L, your ledgers, and everything. And then omitting the recognition of transactions. So you're omitting, suppose a huge cost you had incurred and you have omitted to recognize it itself. And concealing some important facts. There are facts that if you disclose it to the financial statements, that decisions might be affected due to it. You're not disclosing, you're concealing such facts itself. So by using these all techniques, the management can override the control, passing fictitious journal entries, inappropriately adjusting the assumptions, complex transactions, altering records, omitting the recognition of transactions, and concealing the facts. Okay. So how you can remember these techniques of management override of control is peacock, right? Like that, remember peacock. Like peacock, we have peacock. FICAOC, peacock. Okay, that's how you have to remember the management override of control techniques. So now we have understood about the fraudulent financial reporting. The next thing we are going to understand is about the misappropriation of assets. So what is misappropriation of assets? It means theft of entities asset. You do know, like articles, what you guys do, you take the rubber, you take the eraser, you take the what do we say, the calculator and everything, and go to your home. The calculator might be a 500 600 rupees, so to spend, rather than to spend this much, you better take it and go to your home from office itself. So theft of entities asset. So this and all is a misappropriation of asset. This and all is a fraud and you don't realize it. Okay. And committed, it's usually committed by the employees in small and immaterial amounts. Like I told you, a calculator of 500 rupees. Okay. So how can you do such? How can such accomplishment be done of misappropriation of assets? How can you do? Okay. So here they have given four ways of doing it. Yes. So here what you're doing is you're making the entity pay for the goods and services which are not received at all. You have said that a particular good has come into the company, but the entity is also believing it. But actually such good has never come into the company, such service has never been taken by the company, and you're making the entity paid. This is a kind of misappropriation of assets. So here the payment, the cash and bank balance is getting affected. This is also an asset only. And what you're doing, entities are assets, you are using it for your personal purpose. You're not taking it home, but you're using it for your personal purpose. That is also misappropriation of asset only. It is made for the company and not for your own use. Okay. And then the second one is and the third one is stealing of physical assets. So like I told you, you take the calculator and run back to your home. And then is embezzling receipts. You would have heard of teaming and lading, right? So here what happens? So first you get a payment from the first person. Suppose you get 500 rupees. You do not show this in your books and rather you take it home. Second, you get a payment of another 500 rupees, and what you do is this amount you show it as though you have got it for the first payment and you account it here. So like that, whatever you're receiving extra, you're taking it home, and whatever you're receiving afterwards, you're taking it and showing it as you have received it from the previous person. So that what happens, continuously the amounts you're receiving, you're showing it in your books also, but you're showing it late. But you are showing it late. Okay. So I hope you understood this. So like that also, this misappropriation of assets can also happen. But about teaming and lading, if you want to understand in detail, I cannot explain it here. You can watch any YouTube video on teaming and lading. You can just put teaming and lading, you'll get multiple videos and you can understand this technique from there better, in a better form. Yes. Okay. So today we have covered the first page of essay 240 and I would like to stop it here. What we are going to do is in the part 2 of the video we are going to understand the remaining things, which is the fraud risk factors and the related to risk assessment procedures, etc., what you can do. So yes guys, so I hope you understood this video. Wait for the part 2. The part 2's link will be in the description box as soon as it is updated. Yes. So thank you so much for watching this video. If you like this video, please make sure to like, share and also subscribe to the channel. And thank you.